Hello everybody, Jackson here from the Wall Squad today, talking about a trading strategy for you to use. Now this strategy is pretty straightforward, however it doesn't work all the time. It works most of the time, and that's all you really need to make money in the stock market, right? You just need something to work most of the time. You need to practice risk management and you will end up making money. So today we'll be talking about the filling the gap strategy, swing trading specifically, and using the other indicators. This strategy has proved to be pretty useful, so we're going to look into it today. Right away, we're looking at Smile Direct Club, ticker symbol SDC. You can see it fell recently on earnings, and you can see the last two earnings it actually has fallen, right? You can see right here, or I'm sorry, before the earnings it fell from 1060 to 9, and that gap was filled, right? Then we see another drop from 6 to 5, and that gap was filled. And now we see a drop from 5 to 4. Now this company is honestly, you could realize that it's in pain, right? It lost to estimates on the last three earnings reports. However, you could see that every time it jumps down, the gaps down, right? It comes back at least a little bit, at least to the full extent. That's all you really need. So basically, it gaps down and it covers it back up, right? So it fills the gap, and that's all you need to trade a stock, right? You just need to find that pattern. Now using the other indicators, right now we can see it's almost about oversold on the RSI on the yearly time frame, and you can see it's below the 200 moving average, and the MACD isn't showing us anything except it's in a decline. It's not on the way up yet. You can see when it starts to pick up back up, that's the time to get in, and then we see a strong momentum. We talked about the MACD in the latest video. So that's the gap fill strategy, right? This is Smile Direct Club. We're going to look at Peloton. Peloton fell huge since its last earnings report, from 86 now at 49. And you can see in the past, this is actually on the longer time frame. We're just going to go on the year and zoom out because it's easier to look at. You can see in the past the gaps have been filled, right? You can see right here where it gapped down from 125 down to 100, and that gap was later filled. And you can see gap up from 143 to 156, and that was later filled. So it works both ways, gap up and gap down. However, we're not going to be shorting the stock or buying puts. We're just going to be buying the stock, and that requires the stock to be gapping down for us to make money. So we like to see these strategies, right? You see them gapping down and then trading back up, gapping down, and this is trading back up, right? However, if an 86, let's just look at this from the price now, it would have to be an 80% jump, right? And we're not going to expect an instant jump. It's going to be a slow climb, just like all the rest of this. That's not all you need to make money, right? You could buy right here and wait for it just to approach this gap, and you're still making 20%. Opening of the gap, and you're making 30%. That's a huge gain just for one single stock, trading one single strategy, right? All in all, if it works out, you're making 80%. If it doesn't, you're making 30%. If it barely does, you're making 20%. If it doesn't at all, you lose 5%. With risk management. You can see RSI hugely oversold right now, 19, MACD pointing down. However, you can see right here the pain is lessening, right? So it's selling less, and that's what you want to see when you want to buy something, right? Right here you can see start to die down, and that's the time to get some shares in. Right here and right here is when the tide turned. And talking about the signal lines and the actual MACD line, not telling us anything yet. It has yet to turn. But once this blue line crosses over the orange, that's the time to get in, right? That's what the MACD tells us. And the RSI points to oversold. 200, of course, it's under, right? It fell 30% in a day. If it hits back there, we're making 100%. So this strategy ties in with all the other indicators. However, you just got to look at the patterns of the previous gap up and gap downs to see if the stock works with this strategy. Some stocks don't, right? However, we're going to look at Snapchat, another example of the gap up, gap down. So you can see right here, gapped up, has yet to touch it, right? So that's obviously it's in the positive, it's in the green. Another gap up has yet to touch, but you can see this gap up and was just filled by this gap down. So we see this stock starting to turn. You can see it already turning, right? MACD crossed, momentum crossed, RSI above 30. So the stock is pointing to the upside. If it hits even this 200, you're in the green 15%. Fills the gap, you're up 35%. That's just with this one strategy of filling the gap, right? That's all you got to look for, is this tide to change. So don't get into stocks unless the tide is looking to change, right? Peloton could keep falling. It could keep going down, but once this tide changes, and the momentum is a hint, but it's not necessarily an indicator. Once it changes is the time to get in for the ride back up. Maybe not all the way, but at least a little bit, 23%, if you even consider that a little bit. Nike's another play we want to look at. You can see this huge gap up, and this is actually pretty interesting, a test of it, right? It's testing the gap to see how strong it is. So we were testing it right here, it fell below, hit off the 200, right, using another indicator, and went right back up, rebounded fully. Gapped up, tested it, fell through, hit the 200, gapped right back up. Not gapped up, but climbed back up, right? Nike, of course, doesn't look like a huge, amazing play here. It's tides trending on the MACD, but that's besides the point. We're just looking at the time to get in. You can see right here when the MACD changes, momentum changes, RSI above 30, time to get in right around 140, 150. Now share price is 168. So this strategy can be used for many stocks. It's not just these four. However, these are just good examples that I pulled. So you could use this strategy with every other indicator, right? Obviously you should, because the more the better, not necessarily the most, right? You don't want to use all 20, but you want to use a key few that help you with your trading. And that's all for today's video, the gap up strategy, everyone. I hope you enjoyed. Please press the like button and subscribe if you aren't already. We post videos every Monday, Wednesday, and Friday. All right, thanks.